Welcome to Arnerich Massena's third quarter 2016 WebReport Market Update. Hi, I'm Arthur Coyne, Senior Research Analyst. The third quarter of 2016 was a good one for investors. Conservative investments such as Treasury bills and high-quality fixed income had modest gains, while more aggressive investments such as stocks and high-yield bonds rose dramatically, with top performers being among the most aggressive, emerging markets and small-cap stocks. And unlike previous quarters, which were rocked by oil and Brexit worries, the third quarter was fairly calm and supportive to the market rally. Let's now step back and look at the economic picture. This chart shows on the vertical axis the U.S. economy's year-by-year growth, and on the horizontal axis the inflation rate. From it we can see the path our economy has been moving along. We're currently seeing below-average growth and below-average inflation, with inflation gradually trending higher. In September, the Federal Reserve forecasted continued moderate economic expansion, strengthening in labor markets, and inflation increasing towards its 2% target. The Fed voted 7-3 to hold off from raising interest rates in order to support the labor market and a normalization of inflation. The Fed also noted that the case for an increase in the federal funds rate has been strengthening, sending a signal that a rate hike may be coming. In the third quarter, while the U.S. Federal Reserve was on hold and thinking about raising interest rates, most of the world's other major central banks were actively providing aggressive stimulus. Both the Bank of Japan and the European Central Bank were major security buyers using newly created money as a funding source. Known as quantitative easing, these central bank purchases have the potential to drive fixed income and equity prices higher and push bond yields and stock earnings yields lower. This injection of cash and liquidity can help relieve financial stress and stimulate consumption to create real on-the-ground economic growth, which can lead to higher inflation and influence exchange rates. As global central banks systematically drive yields lower, we need to adjust our expectations going forward. For example, the 1.1% average yield on worldwide investment-grade bonds is expected to lead to low bond returns over the next few years. We also see a stock earnings yield of only 4.7%, which is below the trailing average. While a low earnings yield doesn't tell us much about this year's return, it does tend to detract from long-term expectations. Finally, we notice that stock dividends have remained fairly steady at 2.6%, which is above average. This may give investors the impression that stock earnings are still strong, but it's worth noting that companies appear to be keeping their dividends up by reinvesting less of their earnings in their operations. When we review the performance of stability-oriented investments, we see a couple of things. First, we notice that most stability investments delivered near-zero returns, consistent with the low yields and uneventful market conditions that we've been seeing. However, the standout was high-yield bonds, which appreciated alongside equities on investors' search for yield and rising growth optimism. Among stocks, we continue to see strong results in the third quarter across the board, with robust year-to-date and trailing one-year performance. Commodities were the main weak area during the quarter, driven by falling farm prices. Our positioning in fixed income remains tilted towards low duration to manage interest rate risk. We're using credit strategies such as high yield to enhance income, with a bias towards domestic fixed income. In equities, we're emphasizing value and thematic investments and broad global diversification across the full cap range. We favor private markets over the public stock markets where appropriate and continue to pursue return premium and yield opportunities across the entire range of asset classes through active management and innovative investment strategies. Your advisor will keep you informed regarding these opportunities as they become available. Thank you for joining us this quarter.